Hello everyone and welcome back to the podcast. I have two main conclusions having read through HIMS's Q3 2024 earnings report. One, this is a 100x stock. I'm very confident on this call. I believe this is going to be a tremendous investment going forward. And two, that HIMS has a fully viable path forward for its GLP-1 business regardless of what the FDA does with their shortage list or not, via the 503A exception, which is something that I'm going to be talking about in depth in this video, meaning that regardless of what the FDA does with semaglutide, whether it keeps semaglutide on the shortage list or not, the GLP-1 business for HIMS is going to continue growing. This is a very misunderstood aspect of the company, and I think I'm going to make it super easy to understand in this video. So stay tuned because I'm going to be covering that towards the end of the video. All right, so let's get deep into it. Contrary to what the market seems to believe at present, HIMS is not a GLP-1 company. Subscribers grew 44% year over year, and excluding GLP-1 related offerings, they grew at 40% year over year. So out of the 44% growth, only 4% of that is due to GLP-1. Hence, the primary driver of HIMS's rapidly improving financial performance continues to be the expansion of its online subscriber base, which continues to engage with a broadening range of healthcare verticals beyond just weight loss. Additionally, the market is totally misunderstanding HIMS's approach to its weight loss vertical, and as I was saying, I will address that further on in this video. The most important aspect of this quarter is the increasing personalization because it makes HIMS's moat stronger, and you will see towards the end of this video why actually the 503A exception that I was talking about requires the degree of personalization that HIMS is bringing out to the world. At the end of Q3 2024, just over 50% of the entire subscriber base was utilizing a personalized subscription. This does two things: broaden the customer set that HIMS can address with each specific offering, and secondly, increase retention rates. By being able to personalize dosages, for example, HIMS can provide both cures and preventative methods at a marginal cost. So with the same drug, they can cure you for something or they can prevent that condition from developing, and it all comes down to the dosaging. This effectively expands the SAM for HIMS, which is the sizable addressable market, and in turn, personalization drives higher retention by increasing customer satisfaction according to management, thus increasing customer lifetime value and making it harder for competitors to replicate the operation. As of Q3 2024, 65 to 70% of new customers were opting into personalization, so this trend is likely to continue. For example, according to management, some Hearst dermatology subspecialties have seen annual retention rates expand over 20% year over year, as the percentage of subscribers utilizing personalized subscriptions increased 40% year over year to approximately 70% of all subscribers within the specialty receiving personalized treatments. Indeed, as HIMS continues to innovate and increase its efficiency, it will be able to deliver personalized services to more and more people. This dynamic is likely to compound across its growing volume of specialties as more subscribers opt into multi-condition treatments. As of Q3, nearly 300,000 subscribers were being treated for 2 or more conditions on the platform, including subscribers on a single treatment with multi-condition capabilities. In its myopia, the market fails to see HIMS as a machine that delivers better patient outcomes at a lower real price over time, and that is what's actually making the company succeed. As proof of the first element of the equation, which is outcomes, consider the retention rates in GLP-1 treatments. On average, less than 70% of Americans continue GLP-1 treatment after 4 weeks, and that number falls to 42% by 12 weeks. On the other hand, 85% of GLP-1 patients continue engaging with HIMS after 4 weeks, and by 12 weeks, over 70% of patients continue engaging. So the retention numbers are much higher for HIMS than for the American average. In their recent white paper, HIMS shared that subscribers lose 3.6% of their weight in the first month compared to the national average of 4.1%. As testament of the second element of the equation, prices, 4Hers finished Q3 with 400,000 subscribers, with the average household income coming in at $50,000. HIMS's prices make the company a low-cost provider, which in itself is a moat. Combined with the rising personalization and, as a result, better outcomes, HIMS is essentially executing the same algorithm as Costco, but for healthcare. Over the long term, the low-cost nature of the operation will make HIMS fairly resistant to periods of economic hardship. Indeed, I believe that during recessions, people of higher income levels will tend to default to HIMS as well. As you can see in the graph below, in Q3, average revenue per subscriber ticked up to $67 from $57 in Q2 2024. But to the market's credit, much of that seems to be due to GLP-1. According to management, this increase was driven by a continued shift to more premium personalized offerings, which has offset the longer duration commitments that carry a lower average monthly price, which I discussed in the earnings report digest, which I linked to in the written form of this update. Management also credits this increase to the success of the weight loss offering, since the GLP-1 offering started at a higher price point than the other offerings, which have ranged historically from $35 to $55 per month. On the other hand, the oral weight management offering starts at $79 per month, and the GLP-1 offering starts at $199 per month. So you can see how this vertical is definitely driving up the average spend per subscriber on the platform. The GLP-1 success thus seems to be driving some of the cash flow production delta quarter over quarter, which you can see in the graph below. In Q3, net cash provided by operating activities was $85.3 million, which is an increase of 238% year over year. Free cash flow in the third quarter was $79.4 million, an increase of 312% year over year. Meanwhile, total diluted shares outstanding, which include SBC, stock-based compensation, have increased from 210.1 million to 235.1 million year over year, with free cash flow per share thus rising from $0.092 to $0.363 year over year, thus increasing 371% in a year. In Q3 2024, however, HIMS received a $60.8 million tax benefit, which has aided the cash flow production, but the trend remains appealing in my view, as you can see in the graph on the screen now. The question is therefore, what is exactly the viability of GLP-1 revenues for HIMS? Because they are an important driver of the business now, especially as they seem to be driving quite a large part of the growing average revenue per subscriber. At present, HIMS has two paths forward to continue growing its GLP-1 business, which are not mutually exclusive. One, the semaglutide shortage. HIMS and Hers is currently offering compounded versions of semaglutide, which is the active ingredient in medications like Ozempic and Wegovy. This is permissible because semaglutide remains on the US Food and Drug Administration's, so the FDA's, drug shortage list. Once semaglutide gets removed from this list, HIMS can't continue selling it. And that is why the market has been up and down with the stock lately. Also, as I was saying, fundamentally misunderstanding this company as a GLP-1 company, which it's not. It's much more than that. The second route is the 503A exception that I was mentioning at the start of this video. This allows HIMS to create compounded weight loss drugs, regardless of whether the active ingredients are in a shortage list or not, so long as the following conditions are met. One, the medication is compounded for an identified individual patient based on the receipt of a valid prescription order, and the formulation or dose is not available commercially. Two, the compounding must adhere to the United States Pharmacopeia chapters on pharmacy compounding, ensuring quality and safety standards are met. That's a pretty obvious one. And then lastly, the active ingredients used in compounding should comply with USP, the aforementioned United States Pharmacopeia, the national formulary monographs, or be components of FDA-approved drugs unless otherwise specified by the FDA. So what does the above mean? It means that if and when semaglutide gets removed from the FDA shortage list, HIMS can continue delivering GLP-1 equivalents to its subscribers in a personalized and highly individualized manner. Since HIMS's platform's personalization capabilities are getting better over time, this path is a viable one for HIMS to continue growing the GLP-1 business regardless of whether semaglutide remains on the shortage list or not. Thus, the 503A exception allows HIMS to perfectly leverage its personalization at scale capabilities to continue developing its weight loss business over time. Additionally, HIMS management announced in the Q3 earnings call that they will be bringing liraglutide, the first generic GLP-1, to the market in 2025. They allegedly already have a confirmed supplier and expect to quote-unquote complete testing and batch validation over the next few months. Thus, the 503A exception combined with liraglutide gives HIMS a fully viable path forward under normal legal circumstances for its GLP-1 business, regardless of what the FDA does with their shortage list or not. During the Q&A section of the earnings call, CEO and founder Andrew Dudum shared some insightful remarks about this topic. Here's what he said.
The compounding exemption, whether or not on shortage or not, has always allowed for the personalization when clinically necessary, and this can be in form factor, it can be in doses, it can be in combination therapies. There's very well documented and outlined aspects of the compounding exemption for which are allowed and necessary for clinical flexibility. And so the ability to really customize that level of care, we think, is very well respected precedent, very much within the bounds of the compounding exemption. And we also believe is very well respected across all the parties in the industry.
In 2021, Hims & Hers Health acquired Apostrophe, an Arizona-based 503A compounding pharmacy. This acquisition provided the company with compounding capabilities and expertise that serve as the foundation for many of its personalized offerings today. In the Q3 earnings call, Andrew stated that Hims is actively investing in these facilities today and that the company expects the facility to enable them to continue offering personalized weight loss solutions over the long term. I've gone deep into the regulatory aspect of the GLP-1 operation out of curiosity, because before investing, I made sure that I could totally trust the management team to navigate the regulatory space, together with the other complexities involved in the business. Actually, I'm quite surprised with how relatively simple the solution they've come up with is, and I'm fascinated to see how neatly they've managed to craft a path forward for the GLP-1 business. This increases my confidence in the management team further, together with the aforementioned rising personalization levels and overall brilliant execution. Personalization is therefore the way forward for Hims in general, and it's why I started this video with the updates on that front of the operation. In the earnings call, I was delighted to see management state that they expect a significant increase in CapEx in Q4 2024, and that it will be directed towards increasing personalization capabilities and towards increasing automation levels at facilities. An integral part of the Hims thesis is that the company should reinvest more capital over time into improving its operations, but CapEx has been relatively low for the past few quarters, as you can see in the graph on the screen now. Instead, in Q3, Hims has allocated capital towards buying 1.9 million shares at an average price of $15.83 per share, seeing a quote-unquote meaningful disconnect between the market and the intrinsic value of the stock. Lastly, Hims is exhibiting attractive operating leverage, with both GAAP and non-GAAP operating expenses trending down as a percentage of revenue. G&A costs as a percentage of revenue improved 5 points year over year and 2 points quarter over quarter to 11%. Operations and support costs as a percentage of revenue improved 2 points year over year and 1 point quarter over quarter to 12%. Most importantly, marketing expenses as a percentage of revenue improved 6 points year over year to 45%, achieving a new record in marketing leanness for the second quarter in a row. According to management, the increased leanness in the marketing budget is due to the following 3 factors. 1, personalized solutions increasing retention rates, thus reducing marketing spend as a percentage of total revenue. 2, spending marketing dollars on more quote-unquote cost-effective channels. And 3, customers feeling more comfortable discussing their experiences with friends as Hims moves towards categories with less stigma. Accordingly, management expects to drive 1 to 3 points of marketing leverage per year going forward, achieving an EBITDA margin of 20% by 2023. The first time I studied Hims, and the deep dive is in the blog available for everyone, the company's reliance on paid marketing was my primary concern. But once I saw management's superior ability to execute on that front and others that are essential to the operation, I was happy to invest. The rising marketing leverage gives me further confidence that this is an extraordinary management team, as well as the aforementioned execution with the 503A exception. In all, I see Hims executing the same algorithm as Costco, but for healthcare. The number of subscribers on the platform and the average spend continues to trend up. In turn, management continues to exceed my expectations every quarter, and my confidence in totally delegating on them continues to rise. Lastly, in general, there are many possible ways to look at SBC, stock-based compensation. My view is, however, much like in the case of regulatory complexity, that there's no substitute to finding a management team that you can trust. Diluted free cash flow per share for now is up 371% in a year, although this includes the $60.8 million tax benefit in Q3 2024, and there's an infinite number of new healthcare verticals that HIMSS can deploy over time, so I'm a happy shareholder. I see them taking the right steps to get bigger, both in terms of bringing in more subscribers, having them spend more, retaining them for longer. And so I think that this company is positioned to do very, very well over the long term. Right now, it's trading at something like 4 times sales, and this is growing incredibly fast. Only something like, if I'm not mistaken, $300 million less in revenue this quarter than Palantir. So I think that this company is set to be more loved by the market over the coming year or two, potentially. So we shall see. Anyways, thank you very much for joining me today. As always, if you enjoyed this, can you please share it with one friend? These deep dives are for free, and so the only way this grows is with your help. Thank you very much. Take care and stay tuned for the next HIMSS update.